各位女士、先生，大家午安！我是台积电法人关系处的苏志凯，欢迎您参加台积公司2020年第一季的法人说明会。为防范新冠肺炎疫情扩散，本次法人说明会改采电话会议进行。由于本法说会是向全球投资人同时连线转播，所以我们会全程使用英文，请您见谅。Ladies and gentlemen, welcome to TSMC's first quarter 2020 earnings conference call. This is Jeff Su, TSMC's Director of Investor Relations and your host for today. To prevent the spread of COVID-19, TSMC is hosting our earnings conference call via live audio webcast through the company's website at www.tsmc.com, where you can also download the earnings release materials. If you are joining us through the conference call, your dial-in lines are in listen-only mode. The format for today's event will be as follows. First, TSMC's chairman, Dr. Mark Liu, will provide the opening remarks. Next, TSMC's vice president and CFO, Mr. Wendell Huang, will summarize our operations in the first quarter 2020, followed by our guidance for the second quarter 2020. Afterwards, Mr. Huang and TSMC's CEO, Dr. C.C. Wei, will jointly provide the company's key messages. Then Dr. Liu will host a Q&A session where all three executives will entertain your questions. As usual, I would like to remind everybody that today's discussions may contain forward-looking statements that are subject to significant risks and uncertainties, which could cause actual results to differ materially from those contained in the forward-looking statements. Please refer to the safe harbor notice that appears on our press release. And now, I would like to turn the call over to TSMC's chairman, Dr. Mark Liu, for his opening remarks.
Good afternoon, everyone. My name is Mark Liu here. Before we start our financial report, I want to take a moment to thank each of you for joining us online today. To many of you from different parts of the world, in this very time of devastating pandemic, our thoughts and hearts are with you. TSMC so far safeguarded our global operations successfully, but we do not take it for granted. We will continue our utmost efforts to weather this storm, and we are in this together. In the meantime, I want to extend our best wishes to you and your families for staying safe and healthy. So now let me turn the microphone over to Wendell for the summary of operations and current quarterly guidance.
Thank you, Mark. Good afternoon, everyone. My presentation will start with the financial highlights for the first quarter, followed by the guidance for the current quarter. First quarter revenue in NT decreased 2.1% sequentially, which is less than seasonality due to the increase in HPC-related demand and the continued ramp of 5G smartphones. Gross margin increased 1.6 percentage points sequentially to 51.8%, thanks to higher level of utilization, which was partially offset by an unfavorable exchange rate. Total operating expenses decreased by 2.6 billion NT, mainly as 5nm technology moved from R&D stage to mass production during the first quarter. Operating margin increased by 2.2 percentage points sequentially to 41.4%. Overall, our first quarter EPS was 4.51 NT and ROE was 28.4%. Now let's move on to the revenue by technology. 7nm process technology contributed 35% of wafer revenue in the first quarter. 10nm was 0.5% and 16nm was 19%. Advanced technologies, which are defined as 16nm and below, accounted for 55% of wafer revenue. Now, move on to the revenue contribution by platform. Smartphone decreased 9% quarter-over-quarter to account for 49% of our first quarter revenue. HPC increased 3% to account for 30%. IoT increased 8% to account for 9%. Automotive decreased 1% to account for 4%. Digital consumer electronics increased 44% to account for 5%. Moving on to balance sheet. We ended the first quarter with cash and marketable securities of 562 billion NT dollars. On the liability side, current liabilities remain relatively flattish. On financial ratios, accounts receivable turnover days was 42 days. Days of inventory decreased 2 days to 53 days with higher wafer shipment in the quarter. Now, let me make a few comments on cash flow and CapEx. During the first quarter, we generated about 203 billion NT in cash from operations, spent 193 billion in CapEx, and distributed 65 billion NT for second quarter 19 cash dividend. We also increased 20 billion NT in short-term loans mainly for hedging purpose. Overall, our cash balance decreased 25 billion to 431 billion NT at the end of the quarter. In US dollar terms, our first quarter capital expenditures reached $6.4 billion US. I have finished my financial summary. Now, let's turn to our second quarter guidance. Based on the current business outlook, we expect our second quarter revenue to be between 10.1 billion and 10.4 billion US dollars, which represent a 0.6% sequential decrease at the midpoint. Based on the exchange rate assumption of 1 US dollar to 30 NT, gross margin is expected to be between 50 and 52%, operating margin between 39 and 41%. Now I will hand over the call to CC for his key message.
Thank you, Wendell. Good afternoon, ladies and gentlemen. We hope everyone is staying safe and healthy. Let me start with the COVID-19 preventive measurement at TSMC. To prevent the epidemic of COVID-19, many of us around the world have had to change the way we live and work since mid-January. Let me start by sharing something that what we take at TSMC. Our top priority is to protect the health and safety of all our employees at all times. At the outbreak of COVID-19, we immediately suspended all non-critical business travel and restricted visitor on-site access with mandatory health screening. All employees are required to do daily temperature checks with self-declaration, wear masks all the time, and practice social distancing in the office. Since late March, we have taken further preventive actions, such as having employees work from home where possible, and physically separating on-site employees into red and blue teams to reduce the risk of community spread. On March 18th, we found one employee who tested positive for COVID-19 and immediately began receiving appropriate care. Today, this employee has recovered, is out of the hospital, and is staying at home for additional quarantine. We were able to swiftly trace all the other individuals who were in contact. The neighboring employees has all tested negative, while all other employees who were in contact has entered and completed the 14-day self-quarantine and now back to work. As a result of the strict preventive measure taken by TSMC, we have not seen any disruption of our fab operations so far. Now I will talk about our near-term demand outlook. We concluded our first quarter with revenue of NT 310.6 billion or US dollar 10.3 billion, in line with our guidance given 3 months ago. Our first quarter business declined about 1% sequentially, which is much less than seasonality, due to the increasing HPC-related demand and the continued ramp of 5G smartphone. Moving into second quarter 2020, we expect our revenue to be flattish as weaker mobile product demand is expected to be balanced by continual 5G deployment and HPC-related product launches. While we have not seen significant order reduction from our customers so far, we do observe supply chain dislocation and weaker end market demand from COVID-19 in the first half of this year. In the near term, we have observed weaker end demand in applications such as consumer electronics and automotives. Meanwhile, we have also observed better demand from HPC as compared to 3 months ago, driven by the trends such as work from home. Looking ahead to the second half of this year, due to the market uncertainty, we adopt a more conservative view as we expect COVID-19 to continue to bring some level of disruption to the end market demand. For the whole year of 2020, we now forecast the overall semiconductor market, excluding memory growth, to be flattish to slightly decline, while foundry industry growth is expected to be high single-digit to low teens percentage. For TSMC, although this uncertainty exists, we believe we can do better and grow at mid to high teens percentage in 2020 in US dollar terms. All the above forecasts for semiconductor exclude memory market, foundry, and TSMC are based upon the assumption of COVID-19 stabilizing in June of this year. Now let me talk about the progress and development of 5G and HPC. With the recent disruption from COVID-19, we now expect global smartphone units to decline high single digit year over year in 2020. However, 5G network deployment continues and OEMs continue to prepare to launch 5G phones. We maintain our forecast for mid-teens penetration rate for 5G smartphone of the total smartphone market in 2020. We continue to expect faster penetration of 5G smartphones as compared to 4G over the next several years, with substantially higher silicon content. Thus, we believe 5G as a multi-year megatrend is still strong and will fuel the growth of all 4 of our growth platforms in the next several years. HPC will be another major long-term growth driver for TSMC. In the next few years, a smarter and more intelligent world connected by 5G networks will require massive increase in computation power. CPU, networking, and AI accelerators will be the main growth area for our HPC platform. Thus, while near-term uncertainty exists, we will continue to invest in our R&D and technology capabilities to capture the future opportunities from the strong 5G-related and HPC megatrend. We reaffirm our goal to grow at a high end of our long-term growth projection of 5 to 10% CAGR in US dollar terms. Now let me talk about the ramp-up of N7, N7 Plus, and the status of N6. In its third year of ramp, N7 continued to see very strong demand across a wide spectrum of products for mobile, HPC, IoT, and automotive applications. Our N7 Plus is entering its second year of ramp using EUV lithography technology while paving the way for N6. Our N6 provides a clear migration path for next wave N7 products, as its design rules are fully compatible with N7. N6 has already entered risk production and is on track for volume production before the end of this year. N6 will have one more EUV layer than N7 Plus and will further extend our 7-nanometer family well into the future. We expect our 7-nanometer family to continue to grow in its third year and reaffirm it will contribute more than 30% of our wafer revenue in 2020. Now let me talk about our N5 status. N5 is already in volume production with good yield. Our N5 technology is a full node stride from our N7 with 80% logic density gain and about 20% speed gain compared with N7. N5 will adopt the EUV extensively. We expect a very fast and smooth ramp of N5 in the second half of this year, driven by both mobile and HPC applications. We reiterate 5-nanometer will contribute about 10% of our wafer revenue in 2020. N5 is a foundry industry's most advanced solution with best PPA. We observe a higher number of tape-outs as compared with N7 at the same period of time. We will offer continuous enhancement to further improve the performance, power, and density of our 5-nanometer technology solution into the future as well. Thus, we are confident that 5-nanometer will be another large and long-lasting node for TSMC. Finally, I will talk about our N3 status. Our N3 technology development is on track, with risk production scheduled in 2021 and target volume production in second half of 2022. We have carefully evaluated all the different technology options for our N3 technology, and our decision is to continue to use FinFET transistor structure to deliver the best technology maturity, performance, and cost. Our N3 technology will be another full node stride from our N5, with about a 70% logic density gain, 10 to 15 speed gain, and 25 to 30% power improvement as compared with N5. Our 3-nanometer technology will be the most advanced foundry technology in both PPA and transistor technology when it is introduced, and will further extend our leadership position well into the future. Now, let me turn the microphone over to our CFO.
Thank you, C.C. Let me start by making some comments on our second quarter and second half profitability outlook. We have just guided second quarter of 2020 gross margin to be similar to the first quarter. Looking ahead to second half, we expect the steep ramp-up of our 5-nanometer will dilute our second half gross margin by about 2 to 3 percentage points. In addition, our overall capacity utilization may be impacted by the uncertainty from COVID-19. Thus, our gross margin in the second half of this year may be several percentage points lower than in the first half. Looking at our other profitability factors, our leadership in technology development and ramp-up remains strong. We continue to provide value to our customers and drive aggressive cost reduction. Thus, we believe our long-term gross margin target of about 50% is still a good target. Now let me talk about our capital budget for this year. Every year, our CAPEX is spent in anticipation of the growth that will follow in the future years. While the impact of COVID-19 virus brings near-term uncertainties, we expect the multi-year megatrends of 5G-related and HPC applications to continue to drive strong demand for our advanced technologies in the next several years. Thus, we reaffirm our 2020 capital budget to be between $15 and $16 billion. Now, I will make some comments on our capital management and shareholder returns. The objectives of TSMC's capital management are to fund the company's growth organically generate good profitability, preserve financial flexibility, and distribute a sustainable cash dividend to shareholders. With our solid financial performance, strong balance sheet and cash position, and capacity to take on debt, we're able to aggressively invest in our future to enhance our technologies and capabilities. This enables us to continue to outgrow the semiconductor industry, even in an extreme macroeconomic environment like this year. With our rigorous capital management, we remain committed to a sustainable cash dividends on both an annual and quarterly basis. Meanwhile, with the semiconductor industry's highest credit rating, we're able to bolster our cash balance by issuing corporate bonds at a low interest rate. That concludes my message.
Thank you. This concludes our prepared remarks. Before we begin the Q&A session, I would like to remind everybody to please limit your questions to 2 at a time to allow all the participants an opportunity to ask questions. Should you wish to raise your question in Chinese, I will translate into English before our management answers your question. For those of you on the call, if you would like to ask a question, please press the star, then 1 on your telephone keypad now. Questions will be taken in the order in which they were received. If at any time you would like to remove yourself from the questioning queue, please press the pound or the hash key. Now let's begin the Q&A session. Operator, can we please proceed with the first caller on the line, please? Thank you.
The first question we have is from the line of Randy Abrams from Credit Suisse. Your line is now open.
Okay, yes, thank you. Good afternoon. First question was just 2 parts. We wanted to go into the change in forecast versus January. If you could give an update on the change in expectation across your growth platforms, which areas are you revising? And have you seen, I'm curious if you've seen the change in customer orders or you're proactively expecting those to come. And the second part, if you sometimes give a view on inventory levels, factoring your sales have held up implied in guidance, if you could give an expectation on where you think inventory levels at your customers are trending, and if you're factoring in any risk of correction on inventory levels as some of the supply bottlenecks ease.
Okay. Randy, please allow me to try to repeat your question. So your first question is 2 parts. You want to know what is driving the change in our forecast as compared to what we had said in January. Have we seen a change in the outlook for our different platforms? Have we seen changes in customer orders? Or is part of our forecast an assumption of sort of what will happen in the second half? And then the second part of the question is on the fabless and the inventory level that we see. Is that correct?
Yeah, that's correct. Thanks.
All right. This is C.C. Wei. Let me answer that why we change our forecast. Because we do observe some of the end markets become soft. As I stated in the statement, that we saw some consumer electronics such as smartphone or those kind of things has been in the end market become much softer than we thought. However, so we do the forecast not based on the customer's order because of customer today, as I said, we did not see any significant reduction in our customer demand. But we do expect the end demand will have some impact in the following second half of this year. As a result, we change we modify our forecast as compared with January's number. To be specific, except for the HPC has been very strong. All other 3 areas like smartphone, IoT, or automotive are decreasing our forecast as compared with we announced it in January.
Okay, let me take the inventory part. The inventory level of our fabless customers that we track was healthy, exiting fourth quarter of last year. However, given the disruption from COVID-19, we currently expect the inventory level to rise in first half of 20 before digesting in second half of 20.
Okay, Randy.
Okay.
Yeah. Do you have a second question?
Yeah. Okay. Second question, and it really gets into the U.S. There's been press stories about them considering equipment license restrictions, and I'm curious if you could discuss how you're managing the risk or how much risk you see from that equipment license requirement that could affect one of your key customers. And in terms of the CapEx budget for this year, do you still have flexibility to make any changes to this year, either for this factor or for COVID-19 if the impact appears a bit worse? Or is it pretty much locked in for 2020?
Okay, sorry, Randy, you're a little bit breaking up, so let me try to summarize your question. So your second question, first you relate to some of the news reports on the potential for U.S. equipment license restrictions. So you want to understand how does TSMC manage this risk? And then also as related to part of that, what is our CapEx flexibility for 2020 in case COVID-19 situation or these restrictions? Is there flexibility in our CapEx?
Yes, that's correct. Thank you.
Okay, let me answer your question as much as I can. We are now aware that the recent development of U.S. trade rule changes. However, these rule changes is still under draft, and they are informations, but we know that the final rule is not yet finalized. And after the finalized draft, there will be another 30 days of grace period for the industry to respond. In general, we share the concerns, all the concerns of U.S. semiconductor communities, such as voices from SEMI or from SIA. While the draft is not finished, we have studied the various scenarios. And yes, there may be some near-term impact. And we will work with our customer dynamically, and we will take appropriate measures so that to minimize the impact to TSMC. However, for the mid to long term, we think the underlying megatrend still holds, and some supply chain will be readjusted, and the balance is out. So we will be able to still capture our mid to long-term growth opportunities. And therefore, the current CAPEX, long-term CAPEX, we do not see its impact by this change.
Okay, does that answer your question, Randy?
Yeah, and maybe it is the contingency if there's any flexibility, either from this factor if it does go ahead, or if it's more would be more on a forward basis. But if your flexibility, say the COVID-19 doesn't get contained, is largely most of the spending already planned out, kind of time to those megatrends. But if you do have flexibility to adjust that or any potential in a downside case.
So Randy is asking, do we then, for our 2020 CapEx, is there any what is our flexibility in case of COVID-19 uncertainty and such?
Right. We will remain as flexible as we can as we continue to monitor the virus situation and work very closely with our customers. At the same time, the majority of our CAPEX is spent on advanced nodes that drives our growth in the next year and beyond. As we expect the multi-year megatrends of 5G related and HPC applications to drive strong demand for our advanced technologies in the next several years continue, we will continue to prudently invest for our future growth.
Okay, thank you, Wendell. Let's move on to the next caller on the line.
The next question is from the line of Gokul Hariharan from JP Morgan. Your line is now open.
Hi, thanks for taking my question. So could we go through a little bit in terms of how we think about forecasting growth? I think given that if you look at the last 2-3 times where we've had economic corrections, semiconductor industry has seen meaningful declines in revenues. Now we're looking at largely flattish for semi-X memory. So are we expecting that we get a pretty strong rebound into the second half of the year in terms of, so just wanted to go through in TSMC's process of thinking about overall semiconductor industry growth. And since we also expect small inventory correction happening in second half of the year, and I have a follow-up question as well.
Okay, Gokul, let me summarize your question. I think your question is asking, in the past, when there's a severe economic correction, the semi industry also sees a large revenue decline. So why is semi-X memory this year kind of flattish? And how do we explain our full year outlook of mid to high teens? And do we expect a more meaningful inventory correction in the second half of this year? Is that right?
That's right, yeah.
X memory.
Well, the semiconductor, excluding the memory, as I said, that the end market in the consumer electronics will decline. However, as I also mentioned that because of work from home or those communications created a lot of demand on the server, on the wired communication. So the HPC will be very good as compared with our forecast in January. Net, so we give a kind of the semiconductor industry's growth this year probably is a low single digit or to be a little bit negative. That's based on what our forecast today. And what is the second question?
He's asking sort of then, do we expect a meaningful inventory correction going into the second half?
We cannot forecast so accurately, but
Now, let me add something, some color. Now, as CC just mentioned, based on our current outlook, our second half revenue is somehow flattish or may decline slightly. That really gives you an idea that the inventory is digesting in the second half of the year, as for now, as we can see.
Okay, Gokul, does that address? Yeah, go ahead. Your second question?
Yeah, that addresses my first question. Thank you. A second question, could you talk a little bit about the shape of the 5 nanometer ramp up in second half of the year? I think previously, we have talked about this being faster than 7 nano in 2018 and probably around 10% of revenues. Are you seeing any changes to that as a result of some of the weakness that we have seen in the consumer electronic vertical, or for 5 nano, we are still expecting a similar kind of ramp as we expected in January? Thank you.
To be short, we don't expect any change as compared with in January, our forecast. Today, we still see the tape out very on schedule, and the ramp up is also on schedule. Although we did see some of the equipment delivery had been delayed a little bit, but we are working with the equipment vendor. All in all, we think that 5 nanometers ramp up is on track, and we still say that it will contribute about 10% of the total revenue, wafer revenue.
Okay, thank you, CC. Let's move on to the next caller on the line, please.
We have the next question from the line of Roland Shu from Citi. Your line is now open.
Hi, good afternoon. First, congratulations for the very good first quarter result. I would like to follow up for this whole year revenue growth question. I think now you are looking for this mid to high teens percentage point growth for the whole year revenue. So question is, do you factor in any equipment, material, or any kind of ramp up schedule disruption for this supply chain due to this travel ban?
Okay.
No, we did not see any disruption from the material supply or any supply chains activity that has been in disruption mode. Although I did say that because of shelter in home, that some of the tool delivery has been delayed from 2 weeks to about 1 month. However, as I said, we continue to work with tool vendors and minimize the impact on the capacity building. So for the whole year, we don't expect it to have a big impact.
Do you have?
Understood. But how about for the equipment startup point of view? Because of for this shelter in home or travel ban, I think equipment vendor probably won't have enough engineers to do the equipment startup. Will that impact your ramp up schedule?
Well, that has been planned from the outbreak of COVID-19. We already work with an equipment vendor, so they arrange enough engineering resources in Taiwan or all over the world, so we don't worry that portion.
Okay, thank you. For my second question, I would like to ask about your capital management. Normally, I think in the past, you funded all of your CapEx spending from your operating cash flow, and now you just partly funded by issuance of the corporate bond. I think Wendell explained this actually I would like to preserve cash for invest for next growth. So question is, I think first for this issuance of the corporate bond, is there any upper limit you have? I think in order to fund your CapEx, will you continue to issue this corporate bond?
Roland, first of all, we expect our operating cash flow to continue to be sufficient to finance our capital expenditure. Secondly, the decision to issue corporate bond was made before the COVID-19. We look at our future expansion plan, we look at the current interest rates, and we decided it's good timing to issue a low-cost corporate bond just for any uncertainties.
Understood. Okay. And for your cash dividend, I think Wendell, you said you would like to maintain a sustainable cash dividend in both a quarterly and the annual basis. So understood. I think that your annual basis, policy is paying total cash no less than previous years. And how about your quarterly cash dividend policy? Is this at least $2.5 per quarter, per share per quarter, a policy to TSMC?
Okay, Roland, so your question on the cash dividend, you say that our sustainable cash dividend policy on an annual basis means we will not pay less than 10 NT in any year going forward. Then your question is on a quarterly basis, will we pay less than 2.5 NT on a quarterly basis?
No.
Yeah. Okay.
So the quarterly cash dividend will be subject to change. However, the whole year annual cash dividend, I think that will be still maintained to no less than previous years, right?
No, Roland, the quarterly cash dividend will not be lower than the previous quarter. And as a result, you won't have a lower annual dividends than the previous year.
Right.
Okay, so even for let's say for now we are paying $2.5 per share per quarter. So it means going forward our quarterly cash dividend won't be less than $2.5 going forward, right?
Yes, you are correct.
Yes. Okay.
Okay.
Thank you,
Thank you.
Roland. Let's move on to the next caller on the line, please.
Next question is from Bill Lee from UBS. Your line is now open.
Yeah, hi there. Good afternoon, and thanks for taking my question. My first question is on 5 nanometers. It is TSMC's first full EUV node, and it is now in production. So, two-part question. One is, I know this year it is on track, but if you look at the customer adoption going to 2021, can you give us some ideas for maybe the number of customers that are going to use 5 nanometers, or maybe revenue contribution? Secondly, now that we're in production, can you talk about the learning on 5 so far? Specifically, can you talk a little bit about maybe cycle time versus 7 nanometers, the yield ramp, and maybe on the cost side, how it compares to 7, just because it is the first EUV node. Thank you.
All right, you will repeat the question again?
Sure.
I can.
Okay, so Bill's question is on 5 nanometer and EUV, 2 parts. One, he wants to know that we are ramping, we see a steep ramp in the second half of this year, but what does 5 nanometer look like for 2021 in terms of customer adoption, the number of customers, or the revenue percentage contribution in 2021? That's the first part. And then the second part is, can we share some of the learning that we have seen on our 5 nanometer in terms of cycle time, yield, or cost versus 7 nanometer?
Well, Bill, let me answer the first part of first. This year, as we said, that we are going to ramp up, steeply and smoothly. And how about the 2021? You'll continue to ramp up. That's that I can answer you. So, how many customers or how many tape outs? Actually, the customer come from everywhere. I mean, that's a mobile phone, HPC related, and maybe some of them are from the IoT and the automotive. We don't know yet, but today we got a lot of tape out from mobile and HPC related. The cycle time, the yield today is quite good. Actually, it's ahead of our plan. And what is the cost? Cost is reasonable. Of course, we are continue to work on productivity improvement so that we can share with our customer. But as far as I can know, I can understand the cost, the cycle time are all very good. That's all I can say.
Okay. Do you have a second question, Bill?
Yeah. The second question is on COVID-19. And, it looks like the company is doing a really good job of managing it in terms of fab operations. But I'm wondering if you could talk a little bit more about how this might impact your decision-making longer term. How would you change how you're managing the company given COVID-19? For example, does this change your view at all in terms of building a fab in the U.S.?
I don't think that because of COVID-19, we change our decision-making process or we reduce our efficiency. I do believe this is a temporary phenomena. And although I did say that we have red and blue teams, I did say that we have practiced some work from home, but I don't anticipate that this one will continue. So for the long term, just no change. TSMC will continue to work closely with our customer, will devote our resources into R&D, and we are pursuing the manufacturing excellency. Affecting the fab, to build a fab in U.S., I'll let Mark to make some comment.
Well, we do the long-term planning always to the interest of TSMC. And currently, this U.S. fab planning is more for the long term, tap the global talent for TSMC rather than the risk management, because we think that at least COVID-19 is a impact on mankind, but it's a once in a century, and I think we'll learn to deal with COVID-19 as a global community, and while keep our supply chain cost effective and efficient at the same time. So that is what I think. So there's no abrupt decision change because of COVID-19 regarding this fab construction.
Does that answer your questions, Bill?
Yes, thank you very much.
All right, thank you. Operator, can we move on to the next caller, please?
Sure. The next question is from the line of Bruce Liu from Goldman Sachs. You may now proceed.
Hi, good afternoon. I want to ask about the 5G smartphones. So management mentioned that 5G total smartphone growth was revised down the total smartphone shipment, but the penetration rate for the 5G remained unchanged. So can you tell us that, with this COVID-19 or the current situation, any product mix shift when you do the revision? Or, why is that, high-end 5G phone or low-end smartphone, they decline percent? Why is the penetration remain unchanged? And in addition, do you see the 5G smartphone penetration in different geography? Do you see any changes when you do this revision?
Okay, Bruce, sorry, let me repeat your question to make sure we understand. Your question is on the 5G smartphone. As CC highlighted, we revised the total shipments down to a high single-digit decline, but why do we still maintain a mid-teens penetration rate for 5G smartphones? You want to know if we can talk about any product mix shifts that we see in these smartphone, for example, high-end versus mid-end versus low-end, and why our mid-teens has not changed, and also if we can add some detail or color by geography.
Well, let me answer the question first. We did lower down our expectation or our forecast on the smartphone, the total unit, by high single digit. However, we still see the penetration of the 5G smartphone at the same kind of mid-teens percentage. But the number of the 5G smartphone also reduced because of the same percentage with the total number being reduced, so that the 5G phone also reduced. That's one thing. And what is the second question?
And then Bruce wants to know, do we have any detail on between high, mid, low end or by geography?
That's too much of the details. I cannot release that information. But let me say that 5G smartphone has been very, very popular, and we expect that one to grow. Okay.
Okay. Do you have yeah.
I tried to follow up this because for the first quarter, we definitely see that expensive or higher price smartphone, the sales is much weaker than the mid-end and low-end one. So that's why we are surprised that the penetration rate for the smartphone, the 5G smartphone, remain unchanged. Do you have any rationale to support the forecast?
Well, there's a section name called 5G, right? And all I can say is that it's going to be very popular.
I see. Okay, thank you. The second thing is that, we have a lot of investors asking that because of the current situation, the end consumer, the demand is facing some correction. Why is that TSMC, as a standard supply for everyone, does not see a meaningful orders call as of now? I mean, why is that to cause this kind of big time lag between the real end demand situation and the production?
Okay, let me just repeat your question, Bruce. Your question is, when investors are asking, when you look at the end consumer, you could see a very big correction. But why is TSMC not seeing any types of order cuts? Why is there a deviation between what we are seeing and the market?
Or the big time lag, because as management mentioned earlier, management also expect or prepare some orders cut in the second half.
Well, let me answer
So
the
the
question.
time lag between the production control and the consumer demand correction is more than 3 months or 5 months. Why is that cause this delay?
First, you are talking about TSMC's observation from the end market to TSMC's business. TSMC has a leadership in the technology, and we are ramping up the 5 nanometer and 7 nanometer, and that have been very popular and widely used by all the customer. And not every foundry offer this kind of a technology coverage, right? And so we are not, in our technology and our ramping up, we are not seeing any big effect yet. So that will be some delay, the end market to TSMC's business. But we do see that the end market is dropping, so we also expect some demand from TSMC's customer will be adjusted. However, in this COVID-19's impact, we do believe that TSMC will be less affected as compared with other foundries.
So do you expect the orders cut in the second half? Do you expect the orders cut in the second half with more at the legacy node instead of leading node? That's why TSMC can be better than competitors?
I would like to say yes, but let's wait and see.
Okay, thank you.
Okay, thank you, Bruce. Operator, let's move on to the next caller on the line.
The next question is from the line of Sebastian Hu from CLSA. Your line is now open.
Thanks, gentlemen, for taking my questions. There's one that I'd like to follow on the CapEx. So historically, when TSMC, if I remember it right, every time when TSMC lower revenue guidance within the year, the CapEx will be adjusted lower accordingly. Even if just a 5% adjustment on the revenue, you also adjust the CapEx, sometimes even bigger magnitude. This time, it looks like this time the revenue adjustment is as low as 8% or high single digit. The CapEx remain the same. So my question is, first, is it because the TSMC sees something very important, very big, very confirmed in the pipeline till the end of this year or 2021 that you still need to expand no matter what? Or TSMC is sort of losing some flexibility here, given that some equipment supplier or maybe one particular equipment supplier has very long lead time and monopoly power to some extent, and you're also fighting with your competitors, fighting with that equipment availability. So you don't want to cancel that at this point. Which one is more true? Thank you.
Okay, Sebastian, let me summarize your question to make sure we understand. Your question is on our CapEx, and your question is that while we have our full year outlook, we have adjusted versus what we said in January, we are reaffirming our CapEx guidance in January. So you want to know why are we not adjusting our CapEx lower, because our full year outlook has been adjusted. And you propose two reasons. Is it because A, we have confirmed customer demand profile that goes into 2021 and beyond, so that's why we continue to invest? Or is it B, that certain of our equipment suppliers may have a very strong bargaining power, so we have no choice, so to speak, but to continue to spend because our equipment supplier has a strong position. Is that correct?
Exactly. Thanks.
Sebastian, as we mentioned earlier, that we are looking at this megatrend, multiple year of megatrends of 5G related and HPC applications. And these trend continues, the demand for our advanced technology will continue. Most of the CapEx that we spend this year is for the growth of next year and beyond. And that is reason that we are reaffirming our CapEx numbers at this moment. To a certain extent, it may tend to go with your number one options, option A.
I think that's quite clear. Do you have it?
Okay.
Yeah.
Yeah, my second, okay, thank you. So my second question is, I think last quarter, the company gave us some guidance about the four major platforms, HPC, mobile grow 20% plus, IoT, auto grow mid-teens. Can you give us an update now?
Okay, so Sebastian, you want to know what is our updated forecast for the four growth platforms for 2020?
For the whole year?
Yes, for this year.
Okay, smartphone and HPC platform growth will be slightly higher than the corporate average. IoT will be similar, and automotive will be below corporate average. Those are all in US dollar terms.
Okay, does that answer your question,
So
Sebastian?
yeah, that answers. I have a follow on this one, if I may. That the smartphone is still above the corporate average. So that means the smartphone will still grow mid to high teens. So the TSMC forecast the smartphone shipment to decline high single digit. So this year, so which means that the content increase for TSMC is as high as like 20% plus this year in total. Is that right?
You have a very good calculation, and you are right.
Okay, got it. Thank you.
Okay, thank you, Sebastian. Let's move on, operator, to the next caller on the line.
The next question is from Charlie Chan from Morgan Stanley. Please proceed.
Hi, good afternoon. Thanks for taking my question. So I have two questions. One is more short term, and another one is long term, maybe one or 2 years later. So first of all, by compare your guidance versus the previous forecast, it seems like the order cuts reflects to your third quarter revenue. So do you think this year the third quarter revenue is going to be subseasonal? I mean, in terms of the Q&Q growth.
Sorry.
And the 7 nanometer was a pretty tight
Charlie,
at the beginning of the year.
Charlie, we cannot hear you clearly. Can you please move closer to the phone line and start? We couldn't hear your first question. Please repeat it.
Okay, I actually used AirPod Pro, so let me try it again. So first question is about your third quarter revenue. Do you expect that growth is going to be subseasonal? And given some smartphone order cuts, do you still see 7 nanometer capacity is in shortage in 3Q? Thank you.
Okay, so Charlie is asking a short-term question on third quarter. Do we expect our revenue to be third quarter revenue to be subseasonal? Do we expect 7 nanometer to remain full for third quarter?
Charlie, well, we're not giving out the guidance for the third quarter yet, and it's still early, especially under this uncertain environment. We will have a clearer picture in July and share with you.
Okay, what's your second question, Charlie?
Yeah, actually links to that. I guess investors also want to know your internal scenario analysis about COVID-19 impact. I think at an open remark you mentioned the company assumed the virus to peak in June, but there seems to be some signs of the second wave outbreak globally. So in your team's bear case scenario, what would be the
TSMC's growth in 2020? And by the way, the second question is very simple. On 3 nanometer, do you expect customer number and demand in 3 nanometer can compare to what we will have in 5 nanometer? Those 2 questions are both. Thank you.
Okay, that's a little more than 2, but let me just repeat your 2 questions. One, you want to know our internal scenario for COVID-19. We had said, CC had said that it stabilized by June. What if it's worse? What happens to our forecast? That's number 1. And then number 2, for 3 nanometer, what is our customer number of customers and the demand profile as compared to 5?
Okay, let me answer the second question first on the 3 nanometer. All right. 3 nanometer, as I said, our technology development is on track, and we are working with customers to further define the specs and then define the technologies. So, as which one I cannot say, but it's again I can share with you is in mobile phone and HPC related applications. Now the first one, we are talking about the impact of COVID-19, and we are giving our forecast based on the COVID-19 will be stabilized. The impact or the spread over will be stabilizing in June. What happened if it's longer than that? I don't know. I mean, if it's longer than that, the macroeconomies will be much worse than we thought, and definitely will affect the semiconductor industry, will affect the foundry industry, and certainly also it will affect the TSMC. But we don't know yet. Let's be hopeful that all the human beings will be safe and healthy, and everything stabilizing in June.